Welcome back to the Basics of Investing course. Last module, Module 3, we went over the principles of fundamental analysis, or why to buy. And now we're doing technical analysis, the when to buy. So technical analysis is the study of graphs and charts to indicate when a stock is going to boom, bust, or when it's time to get out. First off, let's go over some key terms. First off, the day, month, week, or 52-week range. It's the highest to lowest price in a given time period. So in a 52-week range, that means that in that range, you'll be able to see the highest price and the lowest price. You have the opening price, where at 9:30 in the morning, the price of the stock opens. The closing price, or 4 p.m. when the price of the stock closes. And the volume, which is the amount of stock traded during a given time period. That means how much of this stock is being bought and sold in this one day so far, or in this week, or on and on. And volume is an indicator of how popular a stock is. For example, if a stock is seeing a large downturn, a lot of selling, not a lot of buying, but a large volume, that means that investors or hedge funds or banks are selling off their stock. That is a good indicator to get out of that stock. Technical analysis is a study of stock price movements and patterns using charts and indicators to predict future price trends. Now let's go into how to read a stock chart. Now on the screen, you'll see a graph. This is Fidelity, a website of stock tracking. First off, we have the day or 52-week range on the top. That shows that Apple stock, its range is between $164 to $260 in the 52-week range. It's about a $100 span. So stock's seen some movement. Right now it's at 223, as you can see here, if you track my pointer. And today it's up a bit more than $1 or 53%. Its put-call ratio is 40, so that's a bullish stock. Bullish stock means that the stock is going. A put-call ratio means that there's more calls than puts that day, which means that more investors predict an upward trend. As we can see here, we can see the time on the bottom. It shows what day. The volume, $64 million. Now, this might seem like a lot, but it's important to realize that Apple is one of the most popular stocks on the entire stock market. Because of that, its volume is quite high. If you check a lesser-known stock, such as, let's say, Eli Lilly, on the corner here, I guarantee its volume, it's a lot less. The price is here, and you can maneuver and change this price meter to change the price metrics to see, different ways. Because right now, yes, the stock does seem pretty shaky, but if you were to expand it more, it would seem more, standard and stable. It's very important. Here's the open, the high of the day, the low of the day, the close, and the volume. And this is all, and on top you can also see the bid and the ask price. The ask price is the price that buyers are asking for, and the bid price is the price that sellers are going for. Other way around. The ask price is the price that sellers want, and the bid price is the price that buyers want. Here we have ex-dividend. So this is the next dividend day and the next earnings day. Usually whenever a stock is its earnings, that is a day of massive stock fluctuation based off market response to said earnings. So keep that in mind. Next slide. Stock candles. I know you're going to see a lot of stuff throughout your research talking about stock candles and trying to explain and give a master definition of how to track patterns. Honestly, that is all BS. There's no way and no pattern or no 64-figure strategy guide is going to help you. That really is just incremental at best. And if you get lucky, you get lucky. Candles don't tell the whole story, and you can use indicators to help you out. But personally, I cannot advise any indicators because I don't think they give that much of a help. I think you're way better off with fundamental analysis. But anyways, let's explain candlesticks. First off, it's called a doji. A doji is when there's two very large ends or wicks and one small doji in the middle. That means that the price in this day or in this time period could be a minute, 5 minutes, 15, anything, even a week, even a month. That means that at one point it was here, it opened here on the bottom. No, that means that at one point it was here, one point was here. And the bottom is where it opened and top is where it closed. So this bullish doji opened here at the bottom line and closed higher at the top of the rectangle. And the green shows that it's profitable. And the bearish doji shows that in the wicks, which is the long protruding white parts, it's been there, but it's down. Open here, closed here in the rectangle. And a candlestick is the upper wick, the shadow, the closing price, the opening price, the body, and the lower wick. And stock candles are a way to depict the stock's price. It shows resistance. It shows that the price at one point was here, but buyers became bearish at that point, and sellers won and brought the price down more. yet buyers wouldn't let it drop from the closing price. Let's say this is 1 minute. In that 1 minute, the price was here and went here. Because this doji is bigger, it's not a wick. That means that this is a good indicator of a positive progression. And same for the bearish candlestick. Because it closed down here and has a strong doji, that means that it could be more bearish. But also, 1 minute candlesticks should not be trusted. Do not make decisions off 1 minute candlesticks. For my humble advice, 15-minute candlesticks are the best way to go when it comes to analyzing a stock's daily performance. Now, support and resistance. This is a more fundamental concept to look at. The support price is where a price level where the stock tends to stop falling and bounces back up because buyers step in, and a resistance is a price level where the stock tends to stop rising and reverse because sellers step in and buyers become bearish and stop letting the price rise more and more. As we see here several times in this graph of this unnamed stock, the stock hits this point and corrects itself and drops down. Later on, hits it again and drops down. That means that at 580, that's a resistance. But here, it's a support because several times the stock keeps on dropping down and bounces back up. And many times throughout the course of a day, a resistance can turn into a support and vice versa. It's important to remember support and resistance levels because later on, stock reading and an options trading, it's very important to see where these levels are because usually when a stock breaks its line of support or line of resistance, that is a good indication of a potential pattern or movement in that stock. Now, moving averages. Moving averages serve to visualize the price of the stock over a given time. Moving averages show the average of the stock's growth. If a stock is trading a lot higher than its moving average, that means that it's profitable and it's successful. If it's lower than its moving averages, that visualizes the stock is doing a lot poorer. Moving averages can be used to predict the stock's future and to view the stock as a profitable stock, one that is continuously growing, or one that might be time to call quits on. And also, if a stock is trading too high above its moving average, that's indicated that maybe it's overvalued and soon will face correction. Now, common misconceptions. No matter how much research, how much analysis, how much picking and indicators you use, the stock market is random to an extent. And you are not going to outperform top hedge funds and top traders. Don't think you will. You can trust your gut, but don't put too much money into that. Trust fundamental analysis, stick to a strategy more. Options trading is only for those who have serious skill in the venture, not for everybody. Also, historical indicators are not guarantees of how a stock will perform. Just because you think you can notice or predict a pattern doesn't mean that's what's going to happen. And also, there's more to the story. Stock and chart patterns are not end-all be-alls. Now let's go into some more fundamental theories. First off, the relative strength index, the RSI. Is the stock overbought? Is it oversold? The RSI is used to predict stock movement through momentum. If an RSI is above 70, that means it's overbought. Under 30, oversold. If it's overbought, that means that the stock is due for a correction and will fall, and oversold means that it's due for a correction and the stock will rise. For example, RSI is 100 minus parentheses 100 over 1 plus RS, or relative strength, which is the average gain or average loss period of time. It's important to use RSI to predict when a stock is going to correct itself from a bad day, from a bad week, or when you think it's time to start investing and pull the trigger. And that's that. Thank you for listening to the module on technical analysis. And we have one final module on risk management and diversification.